Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Dr. Komal Sri Kumar, president of Sri-Kumar Global Strategies. Hi, Sri. It's great to see you.
Good to be with you again, Maggie, and nice to chat markets.
Exactly. And there is a lot to chat about. So let's start in the US. We closed out the week with another rally in the Dow. Looks like the S&P taking a little bit of a break in the Nasdaq, giving up a little bit of ground, but overall a winning week, a lot of enthusiasm, and investors seemed relieved today by the PCE inflation reading. We know that's usually a favorite of the Feds. What did you make of it?
Two or three things. One, the PCE number overall is benign, and so I think the market is correct to be pleased about it. But I don't think it was all positive out of it. If you look at it, the year-on-year core inflation rate accelerated from July to August. We went up a little bit. And the core is more important than the headline because the headline was affected mainly by plunging gasoline prices. And so, since the core excludes food and fuel, and that went up, it says that if you have a shock in the Middle East, if you have a problem with the with the war accelerating, you're going to have a problem on the gasoline side. It's going to reflect on the headline again in the opposite way. That's what. Second reason I'm very careful interpreting the PCE number is the fact that housing cost increase was a big part of what happened this in the latest month. And that is to say, rent and owner imputed rent rose by about 0.5% month on month, which is a huge move up. And it is staying there. And it is with how prices being so high and continuing to go up, more and more first time purchasers are going to be pushed into the rental market. So that's going to be a source of it as well. And the third reason I'm cautious, Maggie, is the fact that some of the good numbers came because you were comparing it with the first part of the same month in 2023 when you had relatively high month in annual inflation rates. So this is what we call a base effect. When you compare with a high inflation month 1 year ago, then you're going to look good by comparison because the prices don't increase as much. But October, November, and December of 2023 were low inflation months. Remember, but we had Powell say in December to look for imminent rate cuts in the beginning of 2024. So that was a change. And with the numbers being so low, it's going to be very difficult to match the performance. And therefore, I expect the annual inflation rates to pick up during the
Mm-hmm.
coming months. So those are the things to watch. And through Thursday night, through last night, I was also watching what was happening to the bond yields. The bond yields, after going down, both the 2 year and the 10 year, went up again in the first 4 days of this month.
Mm-hmm.
What is the 10 year afraid about? It is afraid about the fact that inflation could pick up again. Public sector budget deficit is at historical high when you consider that the United States is not at war and the United States not in a recession. Why are we running such a huge deficit?
Yeah, that's a big question. It's interesting you say that because I've been talking about this a lot, asking people about this. Uh, do you I mean, it sounds like they're nervous about does it suggest that they don't believe the Fed? They don't trust the Fed?
Uh, I would say that the bond market is less trustful of the Fed. Yes, that is why the yields went up this week. On the other hand, the equity players are saying, I don't care if the Fed succeeds or not. We have a tailwind at the moment and we need to take advantage of it. So you can understand and rationalize the behavior of both markets, but the fixed income market is what is giving you the danger signal 3 to 6 months ahead.
Mm,
And also, Maggie, keep in mind that neither presidential candidate has done much in terms of explaining how he or she is going to bring down the fiscal deficit once elected.
I don't think they are, Sri. I don't think they have
Yeah,
any intention. That's why they're not talking about it. They're going to add
exactly.
to it. It just
They
depends
are
on
going to
where.
add to it. Right.
Yeah.
All the goodies that they are promising will add to the deficit. So I am really concerned about a bond yield blowout in the first half of 2025. And so all is now nice and peaceful today, and it is like the calm before the storm.
Wow, that's I think really important to underline and to be aware of. And a good distinction when you're trying to figure out, in fact, I tweeted, can everything be right? Stocks are rallying,
Right.
the bond yields did edge down a little bit today and everything's going to be fine for everyone. That's not rarely the case and maybe impossible to be. So it's the time difference that
That's
you
correct.
know, because the equity market is reacting on the here and now in the moment liquidity that they see coming in. The bond market is looking a little bit further out and saying, "Hang on a second, this doesn't add up."
Precisely.
We have too much complacency in the market. Is that what it seems
Exactly.
like?
That
Uh,
is what explains the divergence between the two markets.
It's interesting that you mentioned the potential for inflation, and it being rooted, higher inflation being maybe vulnerable in the commodity market. As all of you who tuned in live know, I was not here live on Wednesday. I was in New York running around, participating in live events around the UN General Assembly. A lot of them were on energy, by the way, so I'm gonna be excited to share, some really interesting observations, that are kind of at odds with the market. But we released an interview I did with Paolo Macro, where he really talked about the oil market and a lot of strange things going on that he is watching and just wondering about and worried if the market isn't setting itself up for exactly the kind of spike you're talking about. Sri, if you have not listened to that interview, I encourage you to go and listen to it and put your thinking caps on, because even if you don't agree, it's really well thought out, reasoned arguments that we should at least all be concerned and watching this, or at least prepared for the risk of it if you look across probabilities. Not that it will happen, but what if it were to happen? Where are we mispriced? And it sounds like you're saying certainly in the stock market, but maybe in the bond market too. If that were to be the case, Sri, where do you see the 10-year going? If you're worried about that kind of blow up or blowout in the bond market, what should we be thinking about in terms of ranges for yields in a world that is not so benign when it comes to inflation, and a world where the Fed may have to react to that?
So let's say that we, after going up, we had some, the 10-year is 357, 358 this afternoon. And let's say that you're looking in the near future over the next couple of months. I have long been saying my target is 3.5%. I was a 10-year bond bull
Mm.
when we were 1 percentage point higher than that, when we were between 450 and 5% on the 10-year. And I said, I'm a real bull. You're going to make money, go long, really keep your money in 10 years and 30 years. I am about to reverse my position. That that play is coming to an end. If we, I'm not sticking exactly by 350. I'm close to my 350 target today. Now, having reached it, I see the risk of it turning around and going the other way. I don't see it continuing to go down.
Mm.
The only thing that can cause the 10-year toward 3 is if you have an absolute crash of the economy and you do not want to go into equities and all the cash is going into US Treasuries seeking safe haven. That's not my forecast. If you do not believe you're going to crash in that manner, you should think of the current setup as probably a bottom for the US 10-year yield starting to move up. How then your question would be, I'm anticipating your question, how high does it go? Let's say we have a new president, and when I am asked how do the elections matter, I've replied it doesn't matter, because neither can, as far as bond market and financial markets are concerned, neither candidate is promising to do anything to cut back on the deficit. If anything, the goodies they give are going to add to it.
Mm.
So if that's the case, I can see the 10-year going up, pick a number, 450 on the 10-year by March or April of 2025.
Wow. Okay. So what is that? Is the U.S. economy? So let's put a pin in that. Where do you? How do you feel about the U.S. economy right now? Can we withstand that kind of higher rate? Is it stronger than we think, which is what some argue? Some still think we're in no landing, or is there weakness, and we would worry about a situation where now we have inflation creeping up, Treasury yields creeping up, but at a time when the economy is struggling? How do you see that relationship?
That is what you're describing is exactly the kinds of things that Jamie Dimon has talked about recently as well, when he looks upon stagflation as a real concern in the market today. And stagflation arises when you have inflation pick up and at the same time the economy stagnates. So you have the worst of both worlds. The economy goes into a recession and the prices go up substantially. So to answer your question, where we are likely to be, if all of the honeymoon we are enjoying ahead of the elections, and let's assume it persists through the new president coming to office January 20th, the markets are patient with the situation. After that, with no resolution to the budget crisis, and the new president will provide the State of the Union message in February, and that is probably not going to be very reassuring. And if that's the case, I say elections don't matter here, but fiscal deficit does matter.
Hmm.
And that's where I can see the prospect of a recession increasing for the first half of 2025. Go back and think about 2007, 2008. The National Bureau of Economic Research, which tells us when recessions began and ended, dates the recession from December 2007 to March of 2009. That's the period of the recession. But you know what happened in the first half of 2008 when we were supposedly in a recession? Stock market surged, the dollar was weak,
Mm,
the oil went to $145 a barrel. Think about it. Today, we have again come down to about half that level. With all the world inflation, we are half that level 15, 16 years later.
mm.
And what happened was, the European Bank, European Central Bank, with it was before Mario Draghi. It was essentially uh, the uh, the name escapes me. The French gentleman who was the
Trichet.
Jean-Claude Trichet. Thank you. Who was the president of the ECB, decided to hike interest rates on July 2nd, 2008, saying inflation is the big risk. Global growth is actually booming. This is 2 months before Lehman Brothers failed.
Yeah.
So the point I make is you do not realize you are in recession until quite a period after it began. And that is, I think, the big risk that I see taking place for the new president in the first 6 to 12 months of his or her administration,
Regardless of who it is, which is
regardless.
probably important because there'll be a blame game either way. So I think this is so important. You know what's interesting, Sri, is that there have been so many warnings about recession, and they haven't materialized, that I think people have become immune to them. Are we in a recession now?
I don't think we are in a recession now,
Mm.
but what the yield curve inversion and the re-steepening, which we had in the last 2 weeks, shows. The 2 to 10, remember, started to invert in July of 2022. That is more than 2 years ago. So 2 years and 2 months later, we started to go positive. And the move to positive happened during the month of September. We started September on a negative basis. What is significant about December 2007, the start of the Great Recession, is that until then, the bond yield curve moved between inversion and coming out of inversion. But in November, December 2007, it steepened and became very positive. Same thing that we are going through today. What the bond market says is watch for the inversion. That is warning you that a recession might come. But as for the timing of it, see when the inversion ends and it starts to re-steepen again. And the reason for that is that the re-steepening happens with a drop in the 2-year yield in anticipation of a lot of fiscal of the Fed easing taking place, and that is what contributes to it. So that's what I'm watching now. I think yes, there have been people who have been saying recession, recession for a long time, but now there are signs why you should worry about it.
Yeah, and it's important to have these risks on your dashboard because even though people want to ride that liquidity wave now, you're going to be going into year end and you're really going to want to think about how you want to position yourself for the risks out there, right? So you can be really
Exactly.
short-term focus now, but you've got to have an eye on what your next move is on the chessboard. I think I'm just looking through the chat and Ched saying Shri was bang on recommending bonds in the past. So giving you a shout out for that, Sri,
No,
and
thank you.
keen to be hearing, that you're reversing that now. And we'll get into a little bit about what you like right now. And Christopher, who is, well, it's 4 o'clock somewhere, certainly 4 o'clock here, says he's choking on his bourbon, but in full agreement with you. Full agreement with you on that 10-year yield forecast. So I
I'd
want to
like
get
to
into
join him on the bourbon, but
yeah,
it's too
wow,
early here. It's
we're
only
all
one
going
o'clock in
to.
California.
Here in California, so it's a little too early. But I certainly want to now, given that we've got these potential risks looming. But it really does echo a lot of what I talked about with Paolo. So I'm really letting this all soak in because it feels funny to have this conversation while things seem so great on the tape. And then you've got to sort of think about those risks out there, as I mentioned. And I just want to get this question from Paul. Wow, Paul, it sounds like you might need a bourbon too. His question is very deep and maybe alarmist. But Shri, do you think it's possible when the U.S. fiscal situation gets bad enough that the government would seize all IRA, 401k, 403b accounts and start a new Social Security program for everyone? It's, I mean, I always like when people express their anxiety and fear. That seems like a longer term question. But do you foresee anything that extreme happening, Sri?
I do not expect that to happen, not because we are in a very benign situation, but I don't expect that to happen because before you run out of money for Medicare, Social Security, unemployment benefits, there is always one weapon the government has to get over it. And that is, again, a right, a privilege which we have in the United States, which Argentina does not have, printing our own money.
Well, it's a privilege
And
we
so,
have for
what
now. Let's see if it
privilege
continues.
we have for now? So, the answer to that gentleman who asked you the question, Maggie, is that the government will pay for it and the financing for it will come from inflating. And that's why I'm not sanguine about inflation at all, because the government needs inflation. They have to water down the level of debt.
Mm.
And to go and default on US Treasuries is unacceptable. Not to make payments for unemployment or other contractual payments is unacceptable. So the only thing you can do is to make the real value of the payment that is made to go down with inflation.
For some reason, I just lost your audio, Sri.
Oh,
So, no,
can you
you're
hear
back.
me now?
You're back. You're back. It was a
Oh, yeah.
momentary. It
Yeah,
was
no,
a
I tried to keep silent for a second.
oh. um. Well, that's good to give us all a moment to soak that in. So this is so fascinating and interesting that you're changing your call and you're thinking about inflation this way again on a day when we're printing what looked like benign inflation. I do want to, and Paul said thank you, that was a great answer. And Paul, I appreciate you asking that because these things seem far away, but they may not be. Whenever we talk about these big events happening, and eventually we'll have to pay for this spending and these deficits, but we don't worry about it because it's far off down the road. There are a lot of people who are thinking about the fact that these effects may be hitting a little bit more short term than we thought of. The kicking the can down the road may not continue in the way that a lot of people think it will. So it's always good to raise those issues. Sri, I want
And
to,
before you go on, Maggie, I
yeah.
would also like to compliment Paul on the question, because that is the difference between trying being an economist and being a trader. And I always say, I'm not an investment advisor, I'm not a trader. What I am is to look at economic tendencies.
Mm.
So when you are focused on the economy and the medium term, you can ignore what happens on a day-to-day and week-to-week basis and say, how does all of this build together and what does it mean for me 6 months down the line? And that's what worries me, even though today's inflation number was very benign indeed.
And this is important, though. This is how you prevent getting blindsided when you've,
Right.
you can trade short term, but you've got to have that macro be checking your framework a little bit further down the line to be able to make the moves. So, in addition to all of this happening in the US, we had some big moves internationally that I want to get your thoughts on, because I know you look at the world and you are focused on monetary policy and economics everywhere. Let's start nearer term with the news today, which was or overnight, really, Japan. We saw some movements, political changes, a new head of the ruling party, and now expectations that perhaps Japan might consider hiking rates. Shigeru Ishibe won the LDP role. He had made comments that he would be in favor of it. Do you think that is political noise? Do you think there's a real chance we'll see Japan rates go higher?
Uh, Again, the first point to make is that the candidate, when he was chosen to be the head of the party, and head of the party in turn eventually means he will become the prime minister of Japan. So
Mm.
one leads to the other. So what he says is very important. It's very significant today. Second point, Japan has long needed to increase interest rates. They maintained negative rates for too long when inflation was picking up, under the supposition that inflation would not reach the target. But Japan is not an island. I mean, not an economic island anyway. And it cannot be free of developments taking place in the rest of the world. And with the rest of the world inflation having picked up, it has to be transmitted to Japan, which is what is what happened. There is recognition, which is why you have had two rate increases so far. And the current head of the Bank of Japan, Mr. Ueda, has stayed away from a third hike because of all the damage that the second hike did to global markets. Remember, August 5th, when Dow Jones fell by more than 1,000 points on a
Mhm.
single day, followed the Japanese rate hike. So that's why I think he's being very careful. But Japan needs to hike rates 2 or 3 more times. And when you talk about the impact on global equity markets, even global bond markets, take that into account. Why? Japan is the largest creditor nation in the whole world. And when Japanese investors are turning inward, or when their interest rates go up,
Mm.
they are taking the money out of foreign stock markets. They are taking the money from dollar denominated and euro denominated paper and taking it back to Tokyo. And when you do that, you're going to feel the effect in the rest of the world. And that's also something today's market behavior is totally oblivious to global developments and what could happen in the next 3 to 6 months, which is why it's important to keep those in perspective, Maggie.
Yeah, it's so important. And there was a lot of talk about that wall of repatriation that may happen when we saw that volatility event and that sort of unwind of the yen carry trade and all of the circumstances that seem to catch people off guard. Will that happen again if we see Japan start to hike rates? How are they going to balance what happens in the dislocating global markets with the underlying need, as you say, for them to increase rates? Can they balance that, or are we likely to see market fallout when they do it?
What has happened so far is Mr. Ueda and the Bank of Japan trying to balance both objectives.
Mm.
So, what does that mean? He has said we, Japanese, do need to increase interest rates, but we are very conscious of what it does to the rest of the world, so we are going to be gradual about it. Soon, you will find a time that by supporting a yield which is very low for the 10-year JGP or Japan government bond, they are essentially wasting the resources. Something needs to be done to correct it. So my expectation is that in the coming months, you would again have to increase the interest rates, and then the objective of liking to balance with the rest of the world is going to be pushed on the side.
Japan and the risk of Japan and repatriation. So I do want to talk briefly against that backdrop. You're talking about a lot of risks. So what happens? What do you like here? Where do you want to be if we're facing what is a benevolent time now, but some very big risks out there as we head into the end of the year, into next year? What do you like?
Great questions. Just because we lost each other, I'm going to say the last couple of sentences I was talking about and then go on to answer your question. They are related. What I was saying was Japan so far has tried to balance its own interests with that of the rest of the world. But my expectation is that if you have a situation when the Japanese have to do it again, they may have to hike rates 2 or 3 more times, irrespective of what it does to the rest of the world. So that means the United States and Europe would have to take care of themselves and find out how they are going to deal with higher rates. Now, what does that do? We talked about how it can cause havoc in both US Treasury market as well as for US equities. Your question, Maggie, was how are you going to protect yourself under those circumstances? And I would say you won't be able to protect yourself in treasuries. You won't be able to protect yourself in equities. You need a third or fourth element of your portfolio. You need commodities. You need inflation protecting devices such as real estate, gold. Look at how it has gone up 27% year to date. Those are the kinds of areas where you need some part of your portfolio to protect yourself.
When we've seen some moves in that, but do we need to is there a buying opportunity to do? We've seen gold moving, but of course some of the other commodities seem like they've been a little bit more muted. What's a good entry time? When do you expect to see them move and respond to some of these risks?
It is always very hard to be a good timer in these markets. But
Yeah.
again, going in line with my saying that you are probably safe until elections and a bit beyond elections, I would probably say you have time till the first week of November. But after that, it's going to be a hard call when the turn is going to happen. So you better use today as a starting point. In fact, gold, I've been saying a year ago was a starting point, and of course we have gone up 27 to 30% since a year ago. And if you did not go in there, I would say gold still has upward potential. Commodities, selected commodities, some of them energy prices have come down. At some point, you're going to say, this is so low for the price of oil, price of natural gas. I'm going to have more of it and I'm going to sit on it for 2 years and you should be doing very well. Those are the ways to protect yourself. If you're thinking of protecting yourself over the next week or two, that's not my profession. That's very hard to say. But if you're looking to protect yourself over a couple of years, then I think it's an easier call.
And before we go, a quick word on China. So we saw that, and this is another thing I think driving some of the near-term sentiment this week. China coming out with several different stimulus announcements, everyone thinking it's finally here. I've seen headlines saying they brought the bazooka out. They're finally going to take aggressive action to right the economy. Does it feel that way to you? And if the US is going to have some hiccups, could China sort of for the global economy be more of a positive force?
Two things to watch out for here. We had these bazookas come out in 2009 with the Chinese, when again, in the aftermath of what happened with Lehman Brothers and the global stock market crash, the Chinese provided immense amount of stimulus for their economy, for their stock markets, and brought it back. What they realized was it was also increasing the level of debt of the government. It was increasing the future pressures. So one thing is, if you are going to be a long-term player in China, that is to say, you're not going in for the next 6 months, you're going in for the next 5 years, you may find that if you go in now and markets go up for another 6 months, there's a letdown when people realize how much the debt has increased. So that's one note of caution. Second, capitalism only goes so far in China. The importance of the government, importance of the ruling party dominates over the stock market. And we see that in terms of the treatment of Alibaba a few years ago, when a company gets too big for its breaches and says they are the top honcho, they are not, they are the top entity compared with the governments of the country, they will probably be called into the office and again to change. Where that will happen and what sectors it will affect, it's very difficult to tell. And that again is another drawback on the Chinese situation. So yes, stimulus is very, very good, but there are non-stimulus related characteristics which are probably going to be more important in the medium term.
And let's round it out with Europe, because that seems like it's mired in a difficult situation. Growth has really struggled. We know that the ECB is again there. The Fed's not the only one cutting. We seem to see this everywhere. I saw someone post something though that Greek yields were lower than French yields. What's happening on the continent?
Greek yield, as I checked it 2 days ago, the Greek yield was running just at about 10-15 basis points higher than France. And Spain and France were having the same 10-year yield. And all of these are unusual. They are not just rare. I think they are happening probably for the first time in modern history. What is happening? The characteristic of Europe is that the southern flank, which is usually lagging, Spain, Portugal, Greece, Italy, and the northern flank, which is usually the dominant one, Germany and France, the northern side is doing very poorly, and the southern flank is doing better. And that is the convergence of these two aspects, that people who do well usually are not doing well at all. And countries which are known as laggards in terms of their economic policy are actually doing very well, making social reforms. Greece has changed its economy phenomenally. Italy has labor force management, which has completely changed the situation under Prime Minister Giorgia Meloni. And I admire the government and what they have done. All of that, I think, is helpful to the fact that the yields are converging between the north and the south. So, but I would say it is more due to the plight of the north rather than even the good nature of the developments in the south that is causing that to happen.
That's very important to say. That is very important to say. That's not great. That's not a great
It's not great. It's not good news, but it tells you that the north, which is much bigger, lot stronger, and usually has pulled the whole region out of a hole, they are doing very badly this time around.
So is there action to be taken? I know you mentioned really briefly before we went on air that there are some interesting comments from Mario Draghi that seem to be completely overwhelmed by all the other news today. What is he suggesting, and does that seem like it might happen?
Mario Draghi was asked by the European Union to provide a report on how the region can improve its competitiveness. He's so highly regarded both in the region and
Mm.
globally that they thought it would be helpful to hear his recommendation and see if they can practice it. Among the things he said was we need a unified capital market like the United States. If we are to compete with the United States, we want a unified market. And the European Union went some of the distance toward it. In the aftermath of COVID, they issued a 750 billion euro common bond.
Mm.
It is not an obligation of Germany, it's not an obligation of Italy, it is an obligation of the entire European Union. They have never issued a common bond so far of this magnitude. And that raised the question, what did it do? That caused Italy to stay in line with the European Union because they got the lion's share of the benefit of the 750 billion euros, but it'll be dribbled out to you over a period of time. And how much you get depend upon how much you comply with European Union guidelines.
It would be
And
that
so
financial cohesion that they really that those last steps that they've never really had. We talked about the
you
fact that this has been the conversation since they launched the euro, that they have a common
right,
currency, they have some common rules, but they don't have integration.
exactly. You said it so well. You have a common currency that reduces the risk of the region itself, rather than by having to go from Italian lira to French franc to German marks. I now have one currency in all of those, the entire region. The second thing that you need is some form of fiscal integration, which we have in the United States
Mm.
and which is sorely lacking in the Eurozone. And that's what Mr. Draghi suggested. It was promptly rejected by the German administration,
Of course it was.
saying, "Oh, we are not going to do that to bail out the profligate countries in the whole region." Which reminds me that the first time it was tried in the United States was in 1789. In the 13 states, Alexander Hamilton, the Treasury Secretary, the first US Treasury Secretary, wanted a common bond. And the reaction was very similar to what Germany had in the past week. They said, why should profligate Massachusetts want to combine with very conservative Virginia in its spending practices? And why would Virginia agree to it? What they found out was that 13 states all were able to issue bonds at a much lower rate than what they would have done by themselves.
Your strongest member makes you better. You're as strong as
Precisely.
it's strong rather than weak as the weakest link, you're as strong as your strongest.
And that is what I think Mr. Draghi was trying to say. I don't know whether they will comply or not by the time the
Would it
German
work?
government.
Is it an idea that has merit?
Yeah, I think it's an idea which has immense merit. I think they should try it. The way to do it is not to give money away. I'm not suggesting that the Germans finance this process
Well, the Germans are the
and then,
weakest right now anyway, so the tide may be turning on who benefits the
right,
most.
exactly right. That's why I'm hopeful that the Draghi plan has some prospect of succeeding because Germany is in such a deep rut, it has to do something to get out of it.
Sri, amazing conversation, some really, really important things that you put on our radar and with a heads up and a warning for us all to be able to adjust and or at least think about adjusting as we kind of look across the end of this year and into next year. Especially because we'll probably be fighting all sorts of headlines about a Santa Claus rally. So good to have a dose of reality from you. I
Thank you,
appreciate
Maggie,
it.
and thank you for your questions and those from your audience. They always make me think
They do.
about all the new things that are happening in the world.
They do. Well, we can't wait to read your Saturday offerings on Substack. It's going to be really good stuff. So thank you.
You're very welcome. Thank you again. Good to be with you.
Yeah, thanks to all of you. Have a fantastic weekend, and as always, take care and good luck out there.